Okay. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi ta'ala wabarakatuh. Thank you, Doctor, for the session of this our presentation for the group project financial 7 for group project 1. We are from group 2, consists of me, Saiful Nazri bin Muhammad Nazir, Puan Asmahani, Puan Azima, and also Puan Encik Muhammad Safwan. Okay, for the topics of this group project 1, financial statement ratio rise flags for financial reporting fraud. So we proceed to the first part of this project, the abstract of the topics. So in the abstract cover in terms of public problem statements, objective, and discussion. So this problem statement will be detailed for the next slide. But in this summarization of the problem statements, there's a red flagging is an early warning system that has been used by auditors to determine the probability of the financial statement fraud. And then the objective is to explore and analyze a possible red flag that can serve as indicators of trouble while reviewing the financial statements ratio, analyzing of the company. And then for this discussions, the financial statement fraud risk is influenced by financial liquidity ratio, profitability, and the leverage ratio that have been proven used to affect the financial statement report, meanings that used for the financial statement report. And then the red flag related to opportunities were more effective lah, means that from the financial statements, they can produce a financial ratio based on the liquidity, profitability, and also the leverage ratio. And then this ratio can be used as one of the tool for the red flags related to the which is more effective for the auditors to be used in terms of red flags tools. Okay, for the background of this topics, according to the report from the Association of Certified Fraud Examiners, ACFE, fraud has increased significantly in recent years and is anticipated to continue to rise for the future. This is based on the ACFE reports of 2014, 2012, and also 2010. Also covered in the financial reporting fraud based on the asset misappropriation and corruption are the categories of fraud which is identified by the ACFE. Also, ACFE 2014 also covered that only 9% of fraud cases involve financial statement fraud, but those cause the greatest financial effect. From the 9% of these fraud cases, there is a significant impact on the greatest financial statements. And then also the knowledge of the red flag is an important factor in preventing and detecting fraud. This is in order to preventing and detecting the fraud, the red flag is very important. And then the financial statement can be used to identify possible red flag and possible a wealth of information about organization health. As we know, the financial statement is the main source of the financial information that can be used by others, stakeholders, and also the important parties, the important entity to know and to read the performance of the company. So the financial statement in this topic, the financial statement is the main source to be used in order in order to provide ratio, and the ratio can be the possible red flag for the parties involved. It can be used. Okay, so for the problem statements here, if we can see that financial statements fraud is related to the difficulty of identifying the fraud soon after it's occurred. So it's maybe based on the management fraud, which is they are trying to not to disclose the information, the fraud involved within the management. The question may rise as to why they should trigger the red flag. So based on the misalignments of expectation, and then the importance to attempt to management the risk of fraud by using early warning signals such as red flags. So financial statement fraud is evident in firms that are experiencing financial difficulties, as cited by NIA 2015. And then the ratio analysis of the financial statement has the ability to detect and give the signal that could demonstrate fraud in financial statement, which is covered in the Kanapich-Kin and Grundian 2015. So for the objective of this project is the purpose of this study to explore and analyze the possible red flag that can be served as indicators of trouble while reviewing the financial statement ratio analysis of the company. So for the next literature review, will be covered from our next members. Thank you.
Okay. I will continue with the literature review. Okay, first in this part, there are 4 parts, which is theory, ratio analysis, financial reporting fraud, and the synthesis part. Okay, first of all, I will explain about the theory. Okay, in this study, we are using fraud triangle theory, which is developed by the Donner-Kresse. Okay, this theory states that fraud is more likely to occur due to the availability of one or more element of the fraud triangle, which is like opportunity, pressure, and the rationalization. Okay, for the pressure to fraud, okay, executive will commit fraud and manipulate as a result of the danger in a company financial stability and the profitability posed by many external forces. Okay, for the external forces here is such as changing in environment condition, negative cash flow, high competition, client need, overgrowth, and others. Okay, the second variable is opportunity to fraud. Okay, opportunity to fraud is the lack of an adequate internal control system. Okay, it's the most significant risk issue in the corporation. Okay, from according Mill et al. 2012, it gives an example. If in the financial statement account like account receivable, account with have a high risk, so it have ability to be manipulated. And then the last variable in fraud triangle theory is the rationalization. Okay, rationalization are the risk factor that may emerge when a small pressure or opportunity arise. Okay, for example here, company which lack effective communication, fail to convey ethic value to employee, and have inadequate wage and reward can cause fraud happen. Okay, next. Okay, for the second part, there is the ratio analysis. There are many studies apply the financial ratio as their independent variable. Okay, as red flags to predict potential financial statement fraud risk because of its simplicity flexibility and known among the financial community. Okay, according to Zainuddin et al. 2016, okay, it defined that financial ratio are also employed in the detection of financial fraud. Okay, financial ratio established based on fraud detection models such as profitability, liquidity, activity, and structure ratio are the most frequently examined. Okay, this is cite from the Kanapikin and Grundian 2015. Okay, meanwhile, according to Guan et al. 2007, is indicate that account receivable and inventory have can prove to be important variable in detecting fraud. Okay, next. Okay, for the third part, which is the financial reporting fraud. Okay, according to the AICPA or American Institute Certified Public Accountant 1998, defined that financial statement fraud is purposeful acts or omission that result in a major falsification of financial statement that is misleading. Meanwhile, according to Spetis 2002, defined financial statement fraud is a financial statement that contain falsification or figure which do not represent the true scenarios. Okay, according to Rizay 2002, said that auditor, investor, and creditor are among the victim of financial statement fraud because they may lose money and or their reputation because when the fraud happen. Okay, there are a few of how to detect of fraudulent financial reporting according to Singleton and Singleton 2010. It have a few ways to detect of fraudulent financial reporting, like first, analysis of financial statement with horizontal and vertical percentage method. Second, making spot check and doing cash count and stock taking without notice. And then detecting whether the fee is determined reasonably according the earning ratio, and they also have a few way to detect of fraudulent financial reports instead of 3 here. Okay, next. Okay, for the last part in the literature review is the synthesis. Okay, in this part we are focused only the 3 ratio, okay, which is the liquidity, leverage, and profitability ratio. Okay, for the liquidity ratio, okay, when if the high liquidity ratio, the corporation have sufficient cash or cash equivalent or current asset to circulate and pay debt. When the company have low liquidity ratio, the company have troubling repay their short-term debt and require management to give cash or asset to settle the obligation. Okay, based on the fraud triangle theory, indicate that the lower a company liquidity, the more pressure it faces, and the higher the possibility of financial statement fraud. Okay, for the leverage ratio, okay, based on this ratio, the leverage ratio can show the ability of company to fulfill the liability in short and long term if there is a liquidation in the company. Okay, based on the fraud triangle theory, when organization have a high level of leverage, they also have a high level of pressure, which increase the probability of financial statement fraud. And then the last synthesis for the profitability. A high profitability ratio indicate that the company can operate efficiently and profitably. This high ratio can contribute to fraud. If the profitability ratio is low, the performance profitability is also low. Based on the fraud triangle theory, if a company is under pressure, such as low profitability, it more likely to conduct financial statement fraud, giving investor and other stakeholder a favorable signal. Okay, so next we can move to the discussion part. Okay.
Okay, thank you, Puan Asmani. So I will continue with the next part. There is a discussion. So under the discussion part, there is a few part also. The first part is the pressure. So under the pressure, there is also three point that we can came out with. Before that, the pressure means that there is the pressure is a factor that will make unethical actions that is caused by the financial and non-financial pressure. So this pressure will show from the value of financial ratio, such as profitability, leverage, and also liquidity. So the first is liquidity. Liquidity ratio had a negative impact on the likelihood of financial statement fraud. But there is no evidence that the auditor's quality weakens the negative association between liquidity and the financial statement fraud. This is according to Tommy Risky et al. 2019. So also according to fraud triangle hypothesis, as the liquidity ratio decrease, then the company is under more pressure, and also it will increase the risk of financial statement fraud. This is based on study by the researcher Zainuddin and Hashim 2016 and also Ashad et al 2015. This is because a company liquidity is linked to its capacity to meet short-term obligation. That this will result in investor in manufacturing companies in Indonesia. The second one is profitability. Profitability has no bearing on the danger of financial statement fraud, according to Tommy Risky et al. 2019. This resulted contradicted the fraud triangle theory and also inconsistent with earlier studies conducted by Asian researcher Zainuddin and Hashim 2016. The findings from Tommy Risky also suggest that profitability has a favorable impact on the risk of financial statement fraud, which is consistent with Reposis 2016, the research in Greece. The third is leverage. Leverage has no positive effect on the risk of financial statement fraud, and the auditor's quality has no effect on the positive association between the leverage and the risk of financial statement fraud, according to Tommy Risky et al. 2019. This finding has contradicts the fraud triangle theory and previous study in Malaysia by Daniel et al. 2014 and Daniel et al. 2013. However, the result is consistent with Reposis 2016 and also research by Hashim and few researchers. Okay, we move to the next slide. The second one is opportunity. In 2022, claims that opportunity is not proven with a significant value of negative 0.96. These findings are supported by research conducted by Setiawati and Baningrum 2018, which they found that the average value of changes in company receivable from the previous years has no effect on the company's cash turnover. According to Yasyariani and Rahayu 2016 also, the number of trade receivable owned by a company did not reduce. The amount of cash available for the company's operational activities imply that the ratio of changes in accounts receivable could not indicate management intent to commit financial statement fraud. Okay, the last one is next slide, rationalization. Rationalization was not demonstrated with a significant score of 0.41 according to Andrew 2022. The findings are also comparable to those researcher by Suyanto 2019 claim that auditors unqualified view cannot be used as a baseline for management to justify fraudulent behavior. Besides, according to Suyanto 2019, the audit opinion really explains the fairness of financial statement preparation. The other one is others. According to Sawangri Rak et al. 2021, 9 financial items related to fraud were found in their study for companies listed in the Stock Exchange of Thailand without considering their business types, such as gross profit, primary business income, ratio of primary business income, and also ratio of capitals and reserve to total debts. So I will pass to the next part to the next member.
Thank you to Encik Safwan, and then I will proceed the last part, which is the conclusion. So according to discussion by our members, so actually financial statements that is a reflection of a company's financial health, which is reflecting useful information about the company financial health. Then actually purposeful misstatement of figure with the intent of fooling financial statement user is referred to their fraudulent financial reporting. And then if the board itself is pressuring employee to make a certain amount of money and that income is related to management bonus, enough motivational stimuli have been created for fast financial reporting bonus. And then promotion is a better position, compensation increase or increase in the company share value, and some of the other incentive also. And then actually the red flags, it's related to the opportunity were more effective for detecting fraud and manipulation. Might be because by the deficiency of internal control system and management system of the companies, especially in our country, in Malaysia, because fraud and manipulation can be seen more frequently in the companies with weak management structure. And then in companies where is which is no internal control system, or in those where it cannot be rendered effective, wrong decision by the management itself, and then fraud in financial statement and loss of asset are actually more commonly seen. And also, actually, without the corporate governance, fraud and manipulation can be occurred easily. And then this red flag, which is was seen more effective to detect fraud by the auditor itself, that show that management system, including internal control system of the company, should be restructured to prevent the fraudulent reporting. And then I think that's all from our group. Thank you.
Okay, thank you.